Welcome back. This is Module 5 of Principles of Insurance and Risk Management. In our previous lecture, we covered loss forecasting. In this lecture, we are covering financial analysis and risk management decision making. Now, let's move to this lecture. First of all, the time value of money. The time value of money must be considered in risk management decision making if there is a cash flows over time. Time value of money considers the interest earning capacity of money. There are two common concepts in time value of money. Number one is present value. Number two is future value. If a present value is converted to a future value through compounding, and a future value is converted to present value through discounting. So the formula of future value is normally denoted by FV equal to PV into 1 plus R to the power n, and the formula of present value is equal to PV equal to FV divided by 1 plus R to the power n. Here R indicates discount rate or interest rate and n indicates number of years. Risk managers commonly use the time value of money when they analyze insurance bids. In the meantime, investment decisions also considers the concept of or investment decisions also apply net present value and internal rate of return in financial decision making or risk management decision making. Let's move to the concept of net present value. Net present value, or simply NPV, equals to present value of cash inflows minus cost or initial investment. So the NPV is simply the sum of present value of all expected cash flows if a project is undertaken, and the discount rate used is the firm's cost of capital. Now let's look at the calculation of net present value. So here NPV is equal to CF0, which indicates initial investment and it is a negative cash flow, plus CF1 indicates cash flows in period 1 or year 1, then CF2 indicates cash flow in year 2 or period 2 divided by 1 plus R. R indicates the discount rate, which is the cost of capital, to the power 1, 2, and these indicates number of periods or number of years. So R here indicates the cost of capital and CFN indicates after tax cash flows at period N. So let's look at the decision criteria. If NPV of an investment is more than 0, the project will be accepted, and if the NPV is less than 0 or negative, the project will be rejected. So here is a calculation of two projects NPV. We are considering project S and project L. Both has a weighted average cost of capital or simply WACC is equal to 10%. So discount rate for these projects is 10%. So this is the calculation of NPV of project S minus NPV is equal to minus 1000. 1000 here is the initial investment plus $500 in year 1 divided by 1 plus 1.10. 1.10 is the discount rate to the power 1. Then 400 divided by 1.10 to the power 2. 2 is the 2 indicates year 2. Then 300 divided by simply 1.10 to the power 3. Then finally, the final cash flow of project S is $100. So 100 divided by 1.10 to the power 4, and the result is 78.82. So the NPV of project S is positive and it is 78.82. So based on the criteria of NPV, so there are two criteria. If NPV is greater than 0, we'll accept it. If NPV is less than 0, we'll reject it. So based on these criteria, without any doubt, project S should be accepted because the value of NPV is more than 0. Similarly, if we calculate NPV of project L, we'll find that the result is 100.40. So second project is also accepted. But if you need to take a decision over here, if you need to choose one project out of these two projects, so you will definitely choose project L, because NPV of project L is more than the NPV of project S. So now the question is, how we will apply NPV in risk management decision making. So I have already said you that project L is better than project S, because NPV of project L is more than NPV of project S. So in this way, we can also we can apply the same method in risk management decision making. If you want to minimize the risks of your investment, you should choose project L over project S, because project L will give you or will generate more value for your business. So in this case, project A, if you need to choose only one project, project S should be rejected. Or in other sense, we can say that project L is safer than project S, or project S is riskier than project L. Now let's look at internal rate of return. This is the rate of return at which NPV of project is 0 mathematically. So IRR is just the rate of return that you will obtain if you invest in a project. In other words, IRR measures profitability of projects. So while NPV will show you what value will be generated by the projects, and IRR will show you how profitable will be your projects. So now the decision criteria: if IRR is greater than cost of capital, you will accept the project, and if IRR is less than the cost of capital, you will reject the project. Here is an example. Suppose you are considering a project that requires $100 investment right now, and after 1 year you will get $110 from this investment, and the project has no other cash flow. So in this way, your investment is 100. After 1 year you will generate 110. So your rate of return will be 10%. So if you apply NPV formula with a 10% discount rate, you'll find that NPV at 10% discount rate will be 0. So IRR of this project is 10%. Here is the calculation of IRR. So you can use this formula CF0, which indicates initial investment, CF1, you know the CF1, cash flow in year 1, divided by 1 plus IRR to the power 1, then 1 plus IRR to the power 2. So here is the calculation of IRR of project S. So minus $1,000, which is the initial investment of project S, then $500 divided by 1 plus IRR to the power 1. In this way, it is going up to year 4. In final year, it will generate $100 cash flows divided by 1 plus IRR to the power 4. So if you find out the IRR using find out the IRR, you'll find that at 14.489% discount rate, NPV of project S will be 0. So IRR of project S is 14.489%. And in the same way, if you calculate IRR of project L, you'll find that at 13.549% discount rate, IRR NPV of project L will be 0. So IRR of project L is 13.549%. So here we can say that project S is more profitable than project L based on IRR. So if we apply IRR in this risk management decision making, we can say that project L is riskier than project S, because project S is more profitable. But keep in mind that IRR has some limitations, like reinvestment assumption of IRR says that project's cash flows should be reinvested at IRR. So for example, IRR of project S is 14.489%. So over the period, like in year 1, it will generate $500, dollar cash flows. This cash flow will you have to reinvest at 14.489%. Again, year 2's cash flows will have to be reinvested at 14.489%. So this is the reinvestment assumption of IRR, whereas NPV assumes that project's cash flows will be reinvested at cost of capital. So here cost of capital is 10%. So based on the NPV, year 1 cash flows has to be reinvested at 10% rate of return, then year 2's cash flows has to be reinvested again on 10% cost of capital. So based on the reinvestment assumption, NPV method is better than IRR method. Now let's look at the results of NPV and IRR again. So based on the NPV, project L is better than project S, but if we look at the IRR, project S is better than project L based on IRR. So if there is any conflict in result for the same project based on NPV and IRR, we should go for NPV. We should go for NPV because the reinvestment assumption of NPV is better than the reinvestment assumption of IRR, or simply IRR, or simply NPV is better method than IRR. So in this case, we should consider that project L is better than project S, or project L is safer than project L. Project L is safer than project S for investment, though IRR shows a different result. So if there is a conflict in result, we should always look at NPV of the projects, and we should consider NPV as a better method in risk management decision making. So that's all about this lecture. In our next 2 lectures, we'll cover NPV in Excel and IRR in Excel, and finally we'll cover other risk management tools. Thank you.